Hey everybody, it's me, the Einstein of Wall Street, out front of the New York Stock Exchange, quarter for 250,000, 250,000 with 3 A's. Take them, episode 9,875 of what the heck's going on? We're out front, the greatest financial institution with the two smartest guys I know in the world, JD and Tim Anderson of the New York Stock Exchange. Reporter, trader, and me, the Einstein of Wall Street. Let's get down, let's get busy, let's get talking markets, volatility. Let's talk about the first half, and let's talk about what we got looking forward to the end of the year, third quarter, second quarter. Boom! That's all I got to say about that. Let's bring it back. So, gentlemen, thank you for coming and joining me. We've had one of the most volatile, one of the most, I would say, one of the craziest topsy-turvy roller coaster first halves in history, right? I would say if I were to come here and we were standing here on the first beginning week of July and we were down 1,000 points, we could more easily explain why we're down 1,000 points than the fact is that we're trading at record highs. Since Independence Day, Dow Jones is up 2,500 points, S&P's up 600 points, and the Nasdaq is up 3,000 points. That is unheard of. With all the uncertainty still going on in the world, it is absolutely amazing that we are still at record highs.
You said Independence Day.
Liberation Day.
Liberation
I'm sorry.
Day.
We just had Independence Day.
Independence Day was 3 days ago.
That's correct. Yeah. Let's go liberation.
We're down since then.
We're down since then.
Yes.
So, all that being said, we've had an absolutely incredible first and second quarter, and I want to go over it and give because you both are going to have completely different views on how we navigated our way through there and what it looks like going forward. I'm going to tip it to you first. Give me your synopsis of Q1, Q2 of 2025.
Well, look, clearly we had the big tariff tantrum when the tariff announcements came out on April 2nd. We went sharply down for a week, maybe a week and a couple of days. Then we stabilized just near what some people would call correction mode. And what we really got, I think, that caught a lot of people off guard was a much sharper V-shaped rebound for the stock market averages than most people would have predicted. I think a lot of people were talking about, well, we need to do some base building from here and go sideways to gradually higher, catch our breath a little bit, figure out this tariff scenario. But we rebounded very sharply up toward the highs and now actually made new highs just in the last 2 weeks of the second quarter.
Let me interrupt you for a second, because you're describing, what he's describing is the first part of, look, let's talk about it. First part of the year, we hadn't had the inauguration yet. A lot of people realize that Mr. Trump, we have people on one side of the coin, we got people on the other side, and I'm not sure what side of the coin I'm on, but we don't need to talk about that. But we're going to have a little bit of a different view on how we navigated our way to this place. Okay, but the first quarter of the year was traumatic in lots of ways. We had the president come in, and a lot of people believed he was a bit of a wild card, having learned what they learned from Q1. Now, we know one thing about Mr. Trump is that the way he disseminates information is a little bit different. Markets can handle anything except uncertainty and surprises. And Mr. Trump is all about uncertainty and surprises, and that's what contributed. From February 19th, when we were at a record high, until April 2nd, and then the notch down to April 9th, this market sold off more than 20%. It was all about tariffs. From the day that we mentioned tariffs are being imposed on Canada and Mexico, 25%, until that whole story unraveled, the market descended into quite a squarey pit that we ended up being in April. But we were able to bounce back. Tim just described, which is quite amazing, Al, because if I were to say to you, look, when we were in the middle of that, we both spoke, the three of us spoke a number of times when we were in the midst of the down part of April, right? It did not, I always said, if we are going to look back at this time, are we going to look back at this time as the time we should have sold because it's going to get a lot worse? Or is this going to be, once again, one of those pullbacks that is a buying opportunity? I think we all would have said, I think it's going to get worse before it gets better. That was not, in fact, the case, because whether it was technical, whether it was the fact that the president told everyone to buy the market, or whether it was a V-shaped recovery, the market bounced back. At the end of the day, the only thing I said with the silver lining about such an aggressive sell-off was, if we, in 11 weeks, if we can sell off more than 22%, we can make it back in just as short a period of time. And in fact, what happened was we made it back in half the time that it sold off, and we got back to even. let's talk to you for a second.
Yeah.
Your interpretation of Q1, Q2. Where do you see? What's your analysis of how we did?
I mean, one of my biggest takeaways from being a Trump White House reporter the first time he was in the administration, I covered Congress, is the big question in D.C. for years. Do you take Donald Trump literally or do you take him seriously? And I think the markets coming into this term were grappling with the same thing. Do we take every little thing that the man says literally, or do we take a step back and more structurally take his negotiating style seriously and not get hung up on the specifics? I would argue when we came into Liberation Day, we hit those April 7th, April 9th lows. That was the market early on taking him a little too literally, word for word. And there wasn't a whole lot of panic from the voices here on Wall Street. A lot of long-term investors said, if you loved NVIDIA when it traded at 141, down at 139, you love it now that it pulled back closer to 100. This is an opportunity to back in the truck and stick to those games of the long-term fundamentals. I think very quickly the market realized what many political prognosticators in D.C. have learned, which is maybe you take him seriously and not literally word for word. And it's been incredible to me to watch the resilience of this market, the degree to which investors very quickly find the silver lining. We don't have those knee-jerk reactions quite as much now as we did in March and April, and I think that V-shaped recovery has been incredible, but a lot of questions about other indicators across the financial markets. Do we see that resurgence from the bond vigilantes? Does the dollar continue to push another leg lower? A lot of big questions about what happens next, but the recovery we've had now up more than 20% off those April 7th lows. We had a lot of conversations. No one wanted to catch that falling knife, but I think it's caught a lot of people by surprise how resilient the market's been, and maybe we've learned to not quite have that knee-jerk reaction to every little post on Truth Social and every single word the president makes when he talks to reporters.
I think that's a really amazing explanation of what we just lived through. Do you want to respond to that?
No, I agree completely, and I think that where we are, you're probably going to get to this, but look, where we are now, the reality of this big, beautiful bill getting signed and going into law literally on the one day after the last market trading day of the first half, or the first market trading day of the second half, is really what's going to set the tone for the remainder of the year, because we've had a big run, and it would be very healthy for the market to catch its breath, maybe pull back a little bit. We've still got some uncertainty on the tariff front, but you just cannot discount the positive and stimulative effects that are going from this bill, that are going to work into the economy over the next at least 12 to 18 months.
What do you see as the most significant part of the bill that's going to have that positive effect on the market and the economy?
Certainly anything to do with the tax implication of lower taxes is going to get a lot of headlines. You have not just accelerated depreciation for new capital investment, but you have immediate expensing of new capital investment. That is almost unheard of. I don't think it's ever been done before. Okay,
explain that to me.
That means that if you're going to spend, typically if you're going to spend $1 billion on new plant and equipment, you actually spend that money now. That would you would have to depreciate that
due
over
to what
10
he's
years.
negotiated a tax
so
law.
you could only use like a tenth of that each year for 10 years as an expense of your business. Now, if you're going to have immediate expensing, that means it's a write-off against current earnings. And so where it's going to be extremely stimulative for the economy, because if you're spending that money is going to somebody. It's going to subcontractors. It's going to, power, electric, plumbing, whatever you want to call it. You've got to, some people would say, the plant's not going to be built for 4 years, but it takes 4 years to build it. There's going to be people on site doing it. So immediate expensing means just an immediate deduction that businesses can take on their current year or two while that expensing is going on. That's never been done before.
My question is it a bill that puts the advantage in those stimulative short-term range at the expense of long-term debt.
There is a little bit of that. There are some benefits that are going to be a little bit front-loaded, but there is also the potential that you are going to have another bill coming out later in the year or early next year that will fine-tune a number of things and address a lot of the issues that, well, the spending cuts aren't really there, that you heard from some of the more conservative members of Congress. And I think that's the way that Trump got them to where they had been a no, and in terms of their principles, had a really hard time voting for this bill.
Sure.
They were given assurances that there would be deeper spending cuts and even rescission bills of prior monies that had been committed to some of the items that we all of a sudden in the new world we don't like.
Yeah.
That some of the spending commitments will be taken away.
Right.
So but there is a reality that some of these benefits are going to be a little bit front end loaded.
Yeah. Yeah. And it's amazing to me politically, something like, I mean, it's one of the things we talk about. This is a massive bill. Let me just to really establish what we're talking about here. This is called a budget reconciliation bill.
Right.
This is quite honestly the BS workaround way to pass a bill in DC when you don't have 60 votes in the Senate to support it. That's the right way you pass legislation. Instead, both parties over the last several decades have weaponized the secret little workaround if you only have 50 plus one in the Senate.
Right.
But we're not really going to pass the bill the right way, the way that more American people would want. We're going to do it with the very bare minimum. And that's why when they did it in 2017, you had so many expiring provisions. The reasons that Trump tax cuts are expiring was because they didn't pass the original bill the real way. They passed it using budget reconciliation, which is the same that Democrats have done.
And a lot of that has become just a political fact that there are not blue dog Democrats like there were for decades that would vote for a Republican-sponsored bill. Keep in mind, when Reagan was president, it was 40 years ago, so it's a long time ago now, that when they passed the first tax bill in 81 and then his second tax bill in 86, the Democrats were in charge of the House of Representatives. Right. So he obviously got a lot of Democrats back then to say, look, we need to try something, let's give this guy a shot, with the tax bill in 81, and then it worked. There were so many signs that it was going to work. They did a follow-on in 86. But that bill had a tremendous amount of Democrats, what they used to call blue dog or moderate Democrats, voting for it. Those don't exist anymore.
Sure.
Okay, let's go for a minute. Let's talk about this for a second, because we know that our political system is so polarized that it's like if you're on one, it's like you can't even have Thanksgiving dinner with your uncle who may be a Trumper or who may be a Democrat. There's such diversity that I guess Hakeem Jeffries had to stand out there for 8 hours and talk just to keep it right. Look, let's deviate from the political part. Everyone was saying that one of the things that Trump was doing, which is super significant in so many ways, was he wants to build America, make America great again, for whatever that means. We were going to start building plants in the United States for Apple. We're going to start changing the way GM and Ford works. We were not able to get guidance going forward. One of the most problematic things that happened about the tariff story was that we were not knowing this. Look, we know that we've learned, whether it's what is it called, the taco trade, right? So Mr. Trump has his standards of negotiating, right? He throws out a big blanket of 185%. He scares everybody woolly, and then he pulls it back, and he ends up making a deal. My gut is that how did we get to where we are today? I want to frame this in a way as we're here at the end of the first half, beginning of the second half. The market, even with all the unknowns around tariffs, around the UK, around the EU, around China, around Vietnam, around Japan, we still don't know that much more than we did on Liberation Day. That's curious, yet the markets are still trading at record highs. How were we able to get here? That's my basic question. We were able to get here for a lot of different reasons. First of all, let's think about the retail investor versus the institutional investor. What we've seen over the last 6 months and probably the last 2 or 3 years is the maturity level of the new retail investor. During COVID, the retail investor was that new person who opened up a Webull or a Robinhood account with their stimulus package from COVID, and they were sitting there trading GameStop and Rivian and all these other names. they've matured a lot. They are not the people. It turns out that the people who sold off the market aggressively in April were institutional and fund managers. They were not the retailers.
Yeah.
Retailers have now got to a level of maturity where they were the ones that were buying the dips. Right, we've gotten to where we are today by young investors who have built up a portfolio that they're here for the long game. Right, think about it. There's no reason why we should be trading at record highs if it wasn't for the fact that the whole landscape of the investment and trading community is at a whole level of maturity that we've never seen before. Yeah. That's the exciting part. So we now, even though the lifeblood of this market is earnings, right? Earnings are what happened last month, guidance what happened next month. At the end of the day, one of the things that's carried this market as high as it is today is that earnings were spectacular last year. We were not able to give guidance. GM, Ford were not able to give guidance. JP Morgan, he came on. Let's even talk about that. We had that time during all of this debacle where JP Morgan, Jamie Dimon, threw a shot across the bow when we had that debacle around the bond market and around China and around all of that. At the end of the day, we need to make nice with all of these trading partners. At the end of the day, China is our largest trading partner. We can only browbeat them to a point where it's either going to come back and smack us in the face, or we're going to end up with a tariff situation that's going to really affect the what do you call it? Why am I blocking on this? Oh my God. The supply chain issues, right? That's a big deal, right? We're already talking about the knapsacks that are going to be delivered to Target in September, right? All of those things were what really had this market shaky. It seems like I would say one thing for the war in the Middle East, it diverted our attention. Right, for a while there, we were all about tariffs. We were all about getting everything against the president. At the end of the day, whatever he did, the Middle East has sort of settled down. With a situation that could have really escalated way worse than it did, whatever he did, we've calmed that down, and now we're back in the mode of addressing.
Go ahead. How incredible, though, by the way, for the markets to continue to rally the Monday after the U.S. gets involved with strikes in Iran. That happened on Saturday night. The president comes out, makes an address. I said to a buddy, watch, the market's going to rally. We're going to finish in positive territory by the end of day Monday. That's exactly what happened. Not based off anything else than the continuation of the momentum that the market has always been able to find that next silver line and the next things to very quickly shift the narrative. The narrative windows are very tight, I feel like, in the market today.
You guys, you're a news guy. The news cycle is so fast.
Yeah, I didn't mean to interrupt. I just mentioned the Middle East.
Please interrupt me. Don't talk to me while I'm interrupting you. You need to interrupt me. That's all. It's all fine and good. But look, there's an old Wall Street adage, meaning when the bombs start to fly, it's time to buy the market, right? So we know in anticipation of wars and global conflicts, right? When that anticipation is over, that's where we see the sell-off. But the minute the shock and awe, the attacks are done, we saw it in the Iraq War, we saw it in the Ukraine War, we sold off for a month leading into the Iraq War, in the Ukraine-Russian War, and the minute the bombs started to fall, we rallied. And we see the same thing here with Mr. Trump. I think all kudos to him, and I'm a firm believer in giving credit where credit is due. The way he handled the Middle East problem was incredibly well, because we were, from an economic point of view, not politically, I don't even want to go there, but we were able to divert our attention. And now, look, where are we now? We are standing, about to embark on Q3. Okay, we are about to enter a market. Where does the market go from here, guys?
Well, we are trading at record high. We will get a lot more guidance after this coming earnings season that's going to start in about a week.
You believe that, even though we don't know much about tariffs? The first quarter,
in the second quarter.
Okay. Why do you believe that?
I just think because we have, we still have some uncertainty over where we're going with tariffs. It's not a complete and total wild card. We have something allegedly agreed to with China,
right?
And we can ballpark what those tariffs are going to be. I think we'll get a deal or two within the next week and a half, and we know that the tariffs are not going to be just as astronomically high as some people had feared after that first rollout on April 2nd. Okay. And I also think that you're going to have economic stimulus items from this
the bill
that people are, the market sometimes looks 6 months into the future.
It is forward looking, no question about it.
people are going to be putting pencil to paper and saying, well, okay, this is what we think capex budgets are going to be, and they're certainly not going to go down.
Okay.
And I think that one thing to think about is where we always have this period, not always, but very frequently, the September-October period time frame for the market is usually very difficult, and on many occasions we've had a very sharp sell-off during that time frame.
Well, it seems to be some kind of historic trauma from October.
I think we had that now in April.
Right.
Okay. So I think that when we get into moving from the end of the third quarter into the fourth quarter, I think we're going to be grinding higher.
So I kind of agree that. I'll toss that to you. What do you foresee? Look, we know I spoke to Dan Ives last week, and he talked about that the capex expenditure by big tech is going to, look, he always talks about it. We are at the second, third inning of a long game that's going into the night. It's a party that we're at 8 o'clock and a party that goes on till 4 or 5 a.m. as far as capex going in, as far as AI goes, right? That has been the leading indicator of everything, and big tech as well has been what's been carrying the market all along. It's a much bigger footprint than that. How do you see Q3, Q4 going forward?
Well, I think that capex number is most important because those are the mega cap consolidated names, for good or for bad. The S&P 500 is market cap, and that means those top 7, those top 8, those top 9%, we know they disproportionately carry the market. As the Magnificent 7 goes, so too goes the market.
Correct.
And we haven't really seen those dents in the armor of the Nvidias, the Amazons, the Apples. Yeah, you get little pullback stories.
Right.
Tesla, very volatile stock, one of the Mag 7.
Right.
Apple, in many ways, has criticism. It has not been able to really generationally innovate in the last few years the way it did many years ago. So you have little kind of parts of the conversation that peel off.
Right.
But for the most part, if that capex spend continues, you continue to have maybe some cost cutting on the margins from some of those companies. You got to imagine they're only entering Q3 in a strengthened position.
Right.
And every day that goes by, Peter and Tim, we are one day closer to, at some point, our friends at the Fed cutting interest rates, even if it is just a quarter of a percent at some point. We don't know if it's going to be this month. We don't know if it'll be September or in December. But at some point, that next rate cut comes. We only hope it's not because of a deterioration of the labor market. We only hope it's because inflation is getting closer. And so I only see that as being tailwinds for the market.
I love that you brought that up, because at the end of the day, our fear was, for a while, what was the butting heads between Jay Powell and the president was that fear. Jay Powell believed that in a low growth or no growth environment, because of tariffs, right, and prices going higher, that to cut rates in that kind of an environment, you're looking at stagflation, right? A stagnant, high inflation, low growth situation. Right now, I think once we've gotten a handle on tariffs, and we're not looking at such a low growth, we're looking at strong growth, especially taking into account the capex expenditure in tech, things are looking better. And in that environment, if you start cutting rates once again, it's going to be that fuel on the fire that the market needs to go higher from here. Do we all agree that Q3, Q4 look like that now? Look, think about it. Let's look at where we are. Let's talk about opinion versus reality. We are now beginning of the third quarter. We are trading at record highs across every friggin' indice. Right. And yet we haven't even gotten an etched in stone deal with China, with EU, with UK, with Japan, with Vietnam. Can you imagine? I know there's been a lot of backdoor diplomacy going on, because it just feels that way from the years of history and experience I have here. Once we start etching these things in history, this market is going to catapult into the next dimension. That's my gut. I mean, once we have that reality and things get settled, think about it. If we sign a solid, good deal with China and we revert to 10%, that's what Dan felt. That we're looking at the end of the day, when all this posturing is said and done, we're going to lock down to 10%, at best 15% at worst, on the tariff side globally. That's going to be okay. Right. And when that is settled in gold, we're talking about this market being, look, Dan was saying he was manifesting a 7 in front of the S&P by year end.
Yeah.
And that wasn't at the end of the number, that was the beginning of the number.
I don't have a problem with that, because you've also got what's close $6 to $7 trillion of cash on the sidelines.
Yes.
You've got a lot of people that were very happy to buy the 10-year at between 4.5 and
Right.
4.9.
Right.
Certainly a higher rate than we've seen in a long time for the 10-year. And now, as the benefits of AI, and let's be realistic, AI will be, as it becomes integrated into a lot more companies' operating
mechanism,
procedures,
right.
AI will be is not going to be inflationary. In fact, it's going to cap inflation, or it's going to reduce inflation, or it's going to be a little bit deflationary, but not in a negative way, because it's going to improve productivity so much. And productivity is a key component of GDP. It's not the most followed indicator. It only comes out once a quarter. But if you get if you get a higher rate of productivity, that just means you can do a lot more with a lot less.
Right.
And that is just economically stimulative.
Beautiful.
But I say though, if you don't mind,
Go ahead.
I don't catastrophize. And I don't think we do ourselves a service when we listen to the overly skeptical voices.
On either side.
On either side.
Yeah.
We know the public posture of a Jamie Dimon tends to be more bearish. CEOs by nature want to be more defensive. They'd rather warn their clients and warn the American people about potential headwinds that never occur, rather than the opposite.
Their job is to protect their
Of
firms
course,
from
which is
disasters.
as opposed to the opposite, which is, well, we saw a few things, but we didn't want to scare you. We didn't want to warn you. To the point of AI, there's something I think a lot about are the warnings from several CEOs in the AI space. Dario Modi's one of them, who says, I don't think we're having as honest enough of a conversation with the American people about how disruptive the American workforce may be in the next even 2 to 3 years because of artificial intelligence that come for a number of white-collar jobs that impact legal fields, that impact fill in the blank here of jobs that historically have gone to high-wage, well-paying employees that need to receive health benefits, et cetera, that overly more and more may become disrupted due to AI. And
so you believe that? You believe? I
don't know. I don't know if it's up to the 10 to 20% estimates that we've heard to say that could be where unemployment goes.
It's a potential issue.
It's a potential issue, and I think it's a.
So
we
that's
only,
curious,
we only
because
do this conversation.
that was my fear before I knew anything about AI, and I was sitting here thinking that when I speak to young people about it, and it was going to outsource every young person. Because look, I speak to a bunch of 18 to 25-year-olds who are really fearful of what the future looks like with AI incorporated into their lives. That getting a job and having a job and finding a field where there's growth is going to be so difficult. And not knowing that much about AI, I went to my man Dan, right? And I said, so is this going to impact all the younger generation in a really negative way and looking to try and find a new career and whatnot? And he felt exactly the opposite, right? I think you're tipping on something that's probably a fact, but the end of the day is what the benefits that we're going to get from AI as from a young person, from the medical field, from the legal field, from this field, is going to be so much more beneficial than the negative side than we would have ever thought. I love surrounding myself by smart people. It makes me look really good. At the end of the day, though, if I were to ask all three of us, is the market going to go up or down? I think we would all say, absolutely. That's what markets do. But at the end of the day, historically, the S&P 500 has gone up. So a little birdie once told me, if you put $250 a month into the S&P 500 at the age of 20, at the age of 60, I know the 60 part's not that sexy, but at $1.4 million of passive income after all those years, it's pretty sexy to me. So anyway, if you've never been involved in the market, it's time to sit there at the crossroads. It's enough sitting there on weekends with all your friends talking about all that money they made trading this market or investing in it. It's time for you to dip your foot in it. Don't think that you missed out on the boat once again. I didn't buy it in April, so I'm not going to buy it and wait for the next pullback. There's never a bad time to buy this market, right?
Absolutely.
Right.
Dollar cost average in. Have your shopping list. We always say the importance of having your shopping list. And compound interest is the eighth wonder of the world. It adds up more than you would think.
You know what, ladies and gentlemen, this is Trade Like Einstein, Tim Anderson, J.D. Durkin, two of the brightest guys I know in the business. And I love you all. That's all I got to say about that.